Ladies and gentlemen, I'm Shashank Bhide, Senior Advisor at NCAER. I'm very pleased to welcome, on behalf of NCAER, all the participants to this workshop, which is fourth in the series of 5 such events on the topic of investor education and protection, which we have launched in collaboration with the National Center for Financial Education. The workshops have focused on investor education and protection, one of the mandates of the financial regulators in different financial sectors. I welcome Mr. Satyajit Dwivedi, CEO of NCFE, who is joining us today and will be providing the overall context for the workshop. As one of the country's premier economic research institutes, NCAER is committed to contribute to evidence-based policies by the governments and civil society organizations and inform general public. At NCAER, the Investor Education and Protection Fund Chair, supported by the Investor Education and Protection Fund Authority of India, is the main organizer of this event. Dr. Krishnan, IEPF Chair Professor, is the spirit behind this initiative on behalf of NCAER. The unit focuses on research on contemporary issues related to investor education and protection. It analyzes, reviews, and the economic, legal, and regulatory issues that are at the root of problems and opportunities. Additionally, the research unit aims to develop knowledge products, case studies, research articles, organizes workshops, conferences, seminars on issues related to this topic. This workshop series draws inspiration from the National Strategy for Financial Education for the next 5 years, 2020 to 2025, as it embodies the thinking of the financial sector regulators on investor education and protection. These objectives have to be implemented within the legal regulatory framework governing the sector. After a launch of this series by Dr. Shaktikant Das, Governor of RBI, we covered the securities market in the first workshop, insurance in the second, and pension funds in the third. The 2 workshops today and tomorrow will focus on payments and settlement systems and banking and credit, directly regulated by the RBI. I welcome Mr. T. Ravi Shankar, Deputy Governor, RBI, has kindly agreed to be with us today to chair the proceedings after the initial context setting by Shri Dwivedi and the opening remarks by Professor Krishnan. Mr. Shankar has held at RBI the portfolio of payment and settlement systems and many other core operations of the country's financial system. We welcome Mr. Shankar. On behalf of NCAER, I would also like to welcome other distinguished speakers and panelists from whom we will learn about the issues that affect informed decisions by the investors and the financial system. Also welcome all other participants who are keen to both listen to the speakers and interact with them in the Q&A session. The end objective of this workshop series is to prepare a sectoral as well as consolidated action plan to implement the recommendations of the NCFE in the light of its findings on the Financial Literacy and Inclusion Survey of 2019. I'm sure there are also lessons learned from the worldwide experience of the COVID-19 pandemic. It's my pleasure now to request IEPF Chair Professor, Dr. Krishnan, to take the agenda of the workshop forward. So thank you, Dr. Krishnan. This is for you to take forward now.
Thank you, Dr. Bhide, and very good morning, all of you. It's truly my pleasure to take over the next steps in the seminar from Dr. Bhide. For those of you who may not know, I'm sure it's only a very few who don't, Dr. Bhide is perhaps our longest serving senior academic in the National Council of Applied Economic Research. In between, he was also director of the Madras Institute of Development Studies in Chennai. Those who are familiar with the RBI will immediately recognize that Dr. Bhide is now a member of the most important body, shall we say, in economic policy making in India, outside of the cabinet, the Monetary Policy Committee. Thank you, Dr. Bhide. Really appreciate your initial words of welcome. Now, it is my privilege to call upon Mr. Satyajit Dwivedi, CEO of the National Center for Financial Education. Just a few words on Mr. Dwivedi and the NCFE and its role in what we are doing today. Satyajit is the CEO, as I said, of NCFE. His areas of interest span across the financial sector, focusing on inclusion, financial inclusion and literacy in particular, and rural and microfinance. He has been a faculty member of the RBI's College of Agricultural Banking and has presented numerous papers on agriculture, value chain financing, microfinance, and rural cooperatives. Today, he is with us to place before us the elements of the National Strategy on Financial Education, the document that was adopted by all the regulators in the FSDC committee, the Financial Stability and Development Committee, chaired by the Honorable Finance Minister in August 2020. This document, in a sense, is the sort of the mother document on the approach of all the financial sector regulators to financial education and literacy, and to the generic issues of investor/consumer protection and finance. So the request to Dwivedi Sahab is to take the next 10 minutes to speak about the NSFE in the context of what we are discussing today, namely payment and settlements, issues relating to consumer education and consumer protection in this subsector. Welcome, Mr. Dwivedi, and over to you now. Thank you.
Thank you, Dr. Krishnanji. Thank you, Shashank Videji, the Senior Advisor, NCAER, and Dr. Krishnanji, the IAF Chair. At the outset, a big thank you to NCAER for involving NCFE and recognizing NCFE as a partner of NCAER in doing this series of 4 workshops with all the 4 sector regulators. Before I start, just a few lines about the NCFE. Of course, Dr. Krishnanji has very briefly touched upon that. NCFE is a Section 8 not-for-profit company, which has been promoted by the 4 sector regulators of the country, like the Reserve Bank of India, the Securities Exchange Board of India, the Insurance Regulatory Development Authority of India, and the Pension Fund Regulatory Development Authority. So these are the 4 sector regulators which have promoted this company, and the basic mandate of NCFE is to promote financial education across the country and to create a financially aware and empowered India. In a nutshell, this is NCFE. And coming to the NSFE, the National Strategy for Financial Education, Dr. Krishnanji has already said that this is a 5-year strategy from 2020 to 2025, which has been approved by the Financial Stability Development Council of India and the subcommittee of, there's a subcommittee under that, the Technical Group on Financial Inclusion and Financial Literacy, which is headed by the Deputy Governor of Reserve Bank of India. This National Strategy for Financial Education has been prepared with the basis of a cross-sectional survey, which has been conducted in a 5-year period cycle. And the previous version of it was fielded in the year 2013 and 14. So 2013 and 14 was the first 5-year survey which was done on financial literacy, and the second survey was done in 2018 and 19. A cross-sectional survey covering about 75,000 respondents across the country, covering all the states in 14 languages. So this is the volume and the extensive consultation that was made in preparing this document of the financial National Strategy on Financial Education 2020-2025. The key objectives of this strategy has been the one is how Indians are doing on indicators of financial literacy. And the second is to inform the ongoing efforts aimed at strengthening financial literacy of the Indians. So these are the 2 basic key objectives on which the strategy is based. And the survey, which was conducted prior to launch of this strategy, has helped us in setting the goals, and it has been a key reference point for measuring change of financial literacy of Indians over a period of time. Just to throw upon few of the main highlights of the survey, which highlighted the national needs and gaps, are at the national level, the financial literacy level is 27%. That means 27% of the Indians are financially literate, which is measured in terms of three parameters, which are the financial attitude, financial behavior, and the financial knowledge. These are the three attributes on which the questionnaires were developed and the respondents were asked to respond. Based on that, the survey was conducted. So this financial literacy level of 27%, which is below 30% at the national level, was 21% in the year 2013-14 survey. So although there has been an increase in the national level literacy, but there are a few issues which are of concern, and this strategy has very clearly identified those target areas, and which are as the following. It says about the strategy again, the overall financial literacy, when I talked, it's measured in terms of the financial attitude, financial behavior, and financial knowledge. The respondents seem to have behaved better in terms of financial attitude, which is 89% of the respondents cleared that benchmark score under the financial attitudes, while 53% passed the financial, the benchmark of financial behavior, and only 49% is the financial knowledge. So these are again the three sub areas of the financial literacy which the survey has very clearly brought out. The other 4-5 critical areas which the survey has told us is, one is the further efforts are needed to improve the financial literacy of the women. That means there's a woman gender disparity in the financial literacy. The woman financial literacy is 21% against the male at 29%. As per the 2019 survey. And then there's a geographic disparities also. The East, Central, and the North zone seem to have be lagging in the financial literacy parameters, whereas the other West and here, they are above the financial literacy national level of 27%. So there are more needs to be done in these geographies in the East, Central, and the North zone. There is also rural India needs to be needs to get the more focus, because there's a divide between the urban and the rural India. There's about 9% gap in that. So rural India needs more focus. The fourth is the target group wise. If you see the group with the lower income and lower education, they need more financial education initiatives. The income level and the education level almost seem to be directly proportional to the low level of financial literacy. Then the group above 50, again, the life stage cycle wise, the group above 50 years of age, they need more financial education initiatives. So these are the 5-6 highlights of the survey which had brought out the needs and priorities at the national level. So what else the survey says? The survey as regards the payment and settlement, if I have to touch upon the cashless transaction, this also says that the findings in relation to almost 63% of the respondents are found to have indicated affirmation of using cashless transactions. 63% of the respondents, and which this prevalence of affirmation is maximum in Northeast, surprisingly 78%, followed by the South zone, which is as 77.8%. They seem to be using the cashless mode. And when it comes to the preferred, most preferred means of remittances, then again, 47% of the respondents, they indicated internet banking is their most preferred center, followed by the debit card at 36%, and then the mobile banking at 31%. So this in the today's workshop, I think this will hold some relevance. This some of the background that I gave about the survey. And coming to the strategy part, the strategy is based on two dimensions. One is the dimension aspect, and the other is we have identified five critical C's on which the policy is mainly anchored. Coming to the strategy part, the three dimensions are the first dimension that the strategy request to address is the life stage of the target audience. That means the children, the young adults, then the adults in the workforce, and the senior citizen. So these are some of the target audience, and in the life stage wise, the Catch Them Young in financial literacy holds as much as it holds in the sports area, Catch Them Young in sports. So that is one thing that we get from the strategy. And then the second dimension talks about the geographies. As I mentioned, the central and the eastern and the north zone with some hilly areas, aspirational districts, they lag behind in financial literacy. So we need, with this geography, along with the focus on the vulnerable social groups in these geographies, which is another dimension which the strategy says need to be addressed. And the third dimension talks about the sector, and which again tries to focus on the informal sector like the agriculture, with special focus on the small and marginal farmers, the MSME, the migrant laborers. And these are some of the informal sectors that, and the SHGs and other farmer organizations, that these are the three dimensions, policy dimensions, the way the strategy has set. And coming to how you go about it, there are very important 5C, which the strategy talks about. The first C is the capacity, or the capacity of the financial education provider. They need to be upgraded and strengthened. So that's through the training and other initiatives. The capacity is one part. The most important part is the content. The NCFE is charged with the responsibility of developing quality and curated content at the national level, which should be followed uniformly across the financial literacy education providers. Then comes the collaboration. So NCFE is open, and NCFE rallies organizations who play a dominant role in this space to join the efforts in promoting financial education. So the collaboration with different stakeholders, including the community participation, the NGOs, the private enterprises. So this is another, and the research organization, of course, like NCAER, and there's a separate chapter on the NCFE which talks about the research and impact assessment over a period of 3-year cycle, and then the final impact and research at the end of the 5 years implementation of the document. Then the fourth will be the collaboration, content and capacity we talked about. Then the communication is another important media, apart from doing the programs on a physical or a digital mode. The digital technology enabled financial, disseminating the financial messages through technology mode is another priority area that the survey has identified. So these are some of the key 5 C's, and the community also I spoke about, the 5C on which the implementation of the strategy is based on. The strategy will consolidate and build on the existing efforts and initiatives by all the stakeholders, especially the regulators. The strategy has very clearly set the action plan. I mean, the 5-year action plan by March 21st to March 25th, who will be doing what and what timeline and what are the actions to be completed. So which is being monitored and reviewed by the technical group on financial inclusion and financial literacy. It's very clear about the stakeholder responsibility. And when I talk about this, it has also talked about the financial literacy is not only of NCFE, because NCFE cannot replace the initiatives and efforts of all the sector regulators and other stakeholders. So it has to be a coordinated way. The strategy has to be implemented. It talks about 3 kinds of financial education. The first being the basic education, which the NCFE should provide through the basic sector neutral content that we have developed through the help of all the sector regulators, and it has got their final approval. So NCFE will do this, and whereas the sector regulator, sector specific education will continue to be provided by the sector regulators, which will bring about behavioral change. It will be basically what to do, the duties and responsibilities, the do's and don'ts, the safe way of using the payments and settlement system. These are some of the things which the sector regulators will do. And there is also a process regulation which will again bring about a significant change in the behavior and attitude by telling them how to use an ATM, how to do a UPI transaction, how to open a BC account, those kind of things, the process. So again, the 3 phases, the basic education, the sector specific education, and the process education. This also says, and that and overall coordination with the Ministry of Finance, Department of Financial Services, who will arrange for the resources, both human and the financial resources required to do this 5-year strategy implementation. So, so we at NCFE we have been and will be implementing over the next months and years about this financial strategy for financial education for 5 years. And we won't be doing it alone, because all the sector regulators and there are several ministries in the central government who have contributed their extensive expertise in creating this document will be anchoring its implementation along with the NCAP. So NCAP would welcome and more such collaborators to join in to take these efforts forward. And according to me, this by bringing together all the regulators and all the stakeholders' efforts, their initiatives, their efforts, and their resources in a new way through a process of convergence will only can make a difference in improving the financial literacy level of the Indians. With that, I think I should end here, and I will be present. And once again, thank you NCAER and thank you Dr. Krishnanji and all of you to have given us an opportunity to share what the strategy talks about and what the service has thrown some of the critical needs and gaps in the financial literacy in India. Thank you.
Thank you very much, Mr. Dwivedi. That was a comprehensive, given the limited time, well covered. You well covered the aspects of NSFE, which needs to be remembered by all of us in the context of today's discussion. It's now my privilege to go ahead with the next part of the seminar. Deputy Governor Ravi Shankar, distinguished panelists, officers of the IEPFA, officers of Government of India, various ministries and departments of Government of India, and officers of financial sector regulatory agencies, my own colleagues from NCAER and all the assembled friends. It gives me great pleasure to restart. We had a break on account of the second wave. So it's really a pleasure to restart and welcome you all to the web-based workshop series of the IEPF unit of NCAER on consumer education and protection in the domain of finance. The thrust of the series, just to clarify, is on education and protection of investors in financial products as well as consumers of financial services. We all know, most of us being academics or experts or people in the area, that we are familiar with the fact that finance is characterized by market failures caused by asymmetric information, both types of externalities, positive and negative, market power, and the provision of public goods. Though information asymmetry is the predominant cause, the other three elements are also present in varying degrees in the provision of different financial services. Historically, and for good reasons, the finance domain forms a distinct and important subset of consumer protection in the generic sense. And it's, I think, in recognition of this, that the Companies Act 2013 has established a statutory IEPFA, Investor Education and Protection Fund Authority. The IEPFA chair of NCAER has chosen as its first activity a detailed and critical appraisal of the NSFE. It's not entirely a coincidence that we both, namely the chair, IEPF chair, and the NSFE, began our lives in August 2020. A critical and comprehensive examination of this document is the primary purpose of this series of workshops with two ends in mind. Number one, promote further empirical research on the topic. And on this, I'm very happy to hear Satyajit opening and making an absolute sort of general invitation to all of us researchers to collaborate with NCFE on these topics. B, recommend measures for strengthening education and protection of the consumer of finance. And it is in this regard that I want to acknowledge the collaboration of the IEPFA and the NCFE in this series. Manoj Pandey, the CEO of IEPFA, Mr. Garg, chairman of NCFE, and his team led by Satyajit Dwivedi and all their colleagues call for a special mention in this regard. Shashank sir mentioned the keynote address of Shaktikant Das, as well as the 3 webinars that we have already carried out in this series. And we have another 2, which we hope to do in the course of today and tomorrow. The endeavor of all of these would be to produce a report of interest to both researchers and practitioners on the next steps in this area. Now, focusing on today's workshop, and I'll just take a few minutes talking about this since we have a far more distinguished panel of experts who will talk about it. Within the financial sector, the pace of change has probably been the fastest in payments, which is being unbundled from the traditional banking services, and this is happening across the world. Technologies like the Unified Payments Interface, the UPI, as well as the exogenous factors of recent times like COVID-19 have accelerated this trend in India also. With increased adoption of digital payments, risks of new users falling prey to various forms of online practices, some purely on account of ignorance and many on account of misdemeanors, have clearly increased. It's to safeguard consumer interest that the RBI has ramped up the supervision capacity with system audit reports, what they call SARs, of authorized payment service operators and Central Payments Fraud Information Registry. Consumer grievance redressal system has also been bolstered with the Ombudsman scheme for digital transactions, for non-bank PPIs, and harmonization of what is called TAT, the turnaround time, and customer compensation for failed transactions in ATMs, UPI, IMPS, PPIs, and card payments. I'm sorry for this soup of alphabets in the form of acronyms. This is something we've learned to live with in this new emerging world of finance. Moreover, a phased approach to implementing ODR, online dispute resolution, across various payment systems is also being considered. RBI is also focused on improving customer convenience by improving upon existing payment facilities such as increased availability of RTGS, enhanced transaction limits for contactless payments with NFC cards, and by streamlining the whole business of QR code infrastructure. There are many other things like increasing competition through the new umbrella entity, but suffice it to say that there is a lot of action of regulatory and policy kind that we are seeing in this sphere. Now, pointedly, I thought, and this is my personal view, there are 5 questions which we could be focusing upon today. Number 1, given the natural tendency of convergence of various financial services, especially over fintech platforms, what are the consumer protection issues that arise in payments and settlement? And are these unique, or are they mostly general concerns across all financial services and fintech ecosystems? Number 2, with the new age technology firms playing an increasing role in retail payments, how might regulators adopt their regulatory and supervisory stance to facilitate consumer-friendly innovations while ensuring systemic stability? Should financial regulators begin to regulate technology firms in the payment ecosystem to ensure consumer protection? Should financial consumer protection attempt try to address privacy concerns in the absence of a data protection law? Third, has concentration risk in retail payments been adequately addressed with the NUE framework? Are ex-ante limits on market share of third-party apps the most appropriate way to address concentration risk on payment systems? Fourth, what are the implications of waiver of charges such as MDR, NEFT, RTGS charges, etc., on business models of payment firms? Are they likely to have medium or long-term consequences deleterious for the consumers in the payments ecosystem? Fifth and last, Has the institutional framework for consumer redressal kept pace with the improvements in consumer convenience in the payments ecosystem? How can an online dispute resolution system, namely the ODR, be better managed at the back end to improve user friendliness and efficiency? Now, it gives me great pleasure to welcome you all to the webinar focusing on some of the issues that I have outlined and many more that will come up, but all focused on payment systems and related sort of subsystems. We have with us today a diverse set of stakeholders who will help us focus attention on all the dimensions of this subject and provide guidance on the way forward. The discussions will be chaired by Ravi Shankar, Deputy Governor, RBI. To begin the proceedings, I will now request Pratik Datta to present the issues for discussion as seen by a scholar researcher who has been following these issues for a long time. Now, before I introduce Pratik and call upon him, a quick announcement on some rules of procedure for conduct of today's proceedings. Each panelist will speak for about 10 minutes. I think one or two have presentations. All of these will be 10 minutes each. I will indicate to them when their time is about to get over, and we will probably inform them through the chat box so as not to disturb the audience. After all the panelists have spoken, we have kept aside 30 minutes for Q&A. To ensure that we do it efficiently, we'll do this through the Q&A box, the chat box that has been set up. All those who have questions, kindly send them in the chat box, indicating if you have a person in mind to answer this. Panelists are requested to take a look at these questions and be ready to respond to these that pertain to them or that they would be interested in. And Raviji, we will note the questions that are addressed to you and collectively inform that lot to you. Pratik, to introduce our key presenter of issues today, is currently a senior research fellow at Shardul Amarchand Mangaldas and Company, an Indian law firm that needs no introduction. His short tryst with conventional legal practice motivated him to pursue an interdisciplinary career in public policy focused primarily on the financial sector. As a researcher at NIPFP, the National Institute of Public Finance and Policy, he regularly published research papers and also advised various government ministries, regulators, and expert committees in formulating financial laws, regulations, and policies. His research interests involve interactions of law, economics, and democratic institutions. He completed his 5-year LLB honors from NUJS Kolkata and an MSc in Law and Finance from the University of Oxford as a Chevening Wiedenfield Hoffman Scholar. Pratik, it's my privilege to welcome you. You have about 20 minutes to speak about issues in investor education and protection in payment and settlement systems. Over to you, and your 20 minutes starts now. Thank you.
Thank you, Dr. Krishnan. I'll just share the slideshow. Can you just confirm if you can see this?
Yeah, we can see your slideshow.
Great. So I'll just start now. Thank you, Dr. Krishnan, once again, your talk kind of sets the tone for my presentation. So first, I think it's important while we begin today's discussion on consumer protection to set the scope of consumer protection. In Indian legal parlance, when we talk about consumer protection, we necessarily think of grievance redressal only. The reason why lawyers are a bit biased towards dispute resolution or grievance redressal actually stems from the Consumer Protection Act of 1986 and now the 2019 Act. This statute is primarily focused on grievance redressal. Ex-ante measures are difficult because the Act is sector agnostic. In fact, if you go into the definition clauses of the Act, the term services includes banking, insurance, electronic goods, you name it, and it will be there. So clearly, this is a non-sectoral law, and therefore ex-ante measures are difficult to implement. Now, in finance, if we exclude the ex-ante and just on dispute resolution or grievance redressal, the discussion will essentially be confined to ombudsman and financial redress, which clearly is a very narrow approach because we know that sectoral regulators like RBI, etc., focus a lot on the ex-ante systemic measures for consumer protection. So therefore, I'll just give an example of what I mean. So for example, under section 23A, which was inserted in 2015, the Settlement Systems Act 2007, bankruptcy remoteness of consumer funds with payments aggregator was introduced. Now, essentially, this is a consumer protection provision, but it is certainly not a grievance redressal provision. So there are such ex-ante systemic measures that determine a lot of the design of the legal system in India as far as financial consumer protection is concerned, and that is not a part of grievance redressal. So in this presentation, I will focus on both the ex-ante systemic measures as well as grievance redressal. However, I understand there can be other viewpoints on the scope of consumer protection, and I would welcome the panelists to feel free to raise whatever issues they consider are relevant. This presentation will only focus on few relevant issues that are relevant as per my understanding of the issues. So the first question that we need to ask is probably, is consumer protection in payments different from fintech? By fintech, I mean the regulated players in the BFSI segment. From the consumer's perspective, technology is driving convergence within fintech. Payments, digital lending, digital banking, investment management, personal finance, insurtech, everything is now on an app. So therefore, a consumer may also want a single platform for fintech grievance redressals. So therefore, it is legitimate to ask, why should consumer protection in payments be any different? Now, to answer this, I will kind of crudely differentiate between some front-end features and the back-end institutions. By front-end, it essentially means features that the consumer has to interact with. All other features of fintech institutions and regulatory systems are at the back-end that the consumer need not even know about. Now, consumer protection in payments relies a lot on back-end clearing and settlement institutions. For example, take something as simple as reversal of a failed transaction. Now, this is something where at the front end, the TAT, the turnaround time for a reversal to happen is very critical for a consumer. But this really depends a lot on the back-end infrastructure for clearing and settlement. So there may be a lot of front-end features whose efficiency is determined ultimately by the efficiency of the back-end institutional arrangement. So when we talk about convergence, we are not obviously talking about convergence of the back-end institutional arrangements, which will differ from sector to sector. But when we talk about convergence, what is relevant for the consumers are convergence of the front-end features. And by front-end features, I will focus mainly on grievance redressal and financial literacy. Now, as Krishna pointed out, there is a market failure in this space which justifies state intervention in grievance redressal and financial literacy. The reason being, if you have a perfectly working grievance redressal and financial literacy system, that creates a lot of positive externalities, but none of the individual private players would be able to capture the benefits of that, although each one of them will benefit from it. In a sense, these goods are non-excludable and non-rival. In public goods, the state has an interest in providing for grievance redressal and financial literacy. So market forces along with technology is driving front-end convergence, but still the state has a role to play in grievance redressal and financial literacy. However, as I'll point out, the consumer protection laws currently do not recognize this trend of convergence as far as the state intervention in grievance redressal and financial literacy is concerned. Consumer protection provisions in India are embedded, as we know, in various sectoral laws. If you take the sectoral laws like Insurance Act 1938, SEBI Act of 1992, Payments and Settlements Act of 2007, PFRDA of 2013, and obviously the banking laws. Now, these laws were designed primarily for the unique back-end institutional systems or structures for each sector. They were never really designed consciously for front-end convergence to benefit financial consumers. And this has been the case across the world, not just in India. However, what we see now happening globally is a convergence as far as the front-end features are concerned, essentially financial literacy. So take the example from Canada, the Financial Consumers Agency Act of 2001. Now, I'll just quote you the section 2 of this statute, which lays down the purpose of this act. So it says the purpose of this act is to ensure that financial institutions, external complaints bodies, and payments card network operators are by an agency of the government of Canada so as to contribute to the protection of consumers of financial products and services and the public, including by strengthening the financial literacy of Canadians. So essentially, Canada has come up with a dedicated legislation to handle the front end aspects of consumer protection. Similarly, the US Dodd-Frank Act in Title 10 creates the Consumer Financial Protection Bureau, the CFPB. CFPB ensures that federal consumer financial laws so that consumers may access markets for financial products and so that these markets are fair, transparent, and competitive. Now, in this backdrop, a question that is worth asking is, do we need a Financial Consumer Protection Act for India, which will specifically deal with financial literacy and grievance redressal across the financial system, not just across sectors separately? Now, this is a larger question which I'll pose for the panel for further discussion, and we can discuss the details subsequently. Now, moving on, the next question that ought to be asked as far as payments regulation is concerned is, where does payments end and where does tech and commerce begin? So let me just give you a bit of a legal context. In 2009, RBI came up with the intermediaries directions, whereby it primarily regulated the intermediary collecting consumer funds in payments. These were the payments aggregators. It also acknowledged the technology players, the payments gateways, and the e-commerce platforms. In 2020, the guidelines on payments aggregators and payments gateways were issued. It again clearly differentiates between PAs and PGs based on whether they collect customer funds or not. So PAs, as in payment aggregators, are the ones which collects the customer funds and therefore are subject to higher degree of regulation. So this guideline formally applies to PAs, and the guidelines have only recommendatory value to the PGs as far as the baseline's technology is concerned. However, interestingly, it also directly regulates the merchants. Merchants are prohibited from storing customer card data. Now, this comes from clause 7.4 of the 2020 guidelines. Now, this is the direct regulation on merchants, or rather the direct ban or prohibition on the merchants, is over and above certain other safeguards in the regulations. So, for example, the PA, that is the payment aggregator, is responsible to ensure that the merchant infrastructure complies with data security standards. And in case of breach of consumer card data due to failure of the PA, the capital requirement on the PA could be used to ensure that pecuniary sanctions can be effectively imposed on the PA to compensate consumers. But even then, the regulator has gone on to impose a prohibition on the merchants. Now, there are genuine concerns here. Just because a player is not technically a financial market player does not mean that it does not pose risks to financial consumers in that market. However, traditionally, the way our laws are structured is that a financial regulator only regulates financial players, and therefore this raises the question that should financial consumer protection extend to directly regulating non-financial players? And the second question also that arises here is that should financial consumer protection address privacy concerns in the absence of PDP? Because the storing of consumer card data will also have privacy implications. There are other two issues also here. So one is that this particular ban seems to affect only the cards, but not the other payment systems. Now, this can be seen as a breach of the technology neutral requirement that is expected of financial consumer regulations under principles like the OECD financial protection principle, which requires that financial consumer protection rules are technology neutral. And in this context, it is particularly important because this problem could have been probably been solved by the technology of tokenization, which essentially masks the customer card data with the same characteristics, same length of other characteristics. And in spite of that technology, does it make sense to impose a ban which is clearly not technologically neutral? So these are questions that we could probably request the panel to consider. The next issue would be, should consumer protection in payments extend to price control? Now, to put context, in the budget speech of 2019, businesses with, it was proposed that businesses with annual turnover above 50 crore should offer digital payment options, and no MDR, that is merchant discount rate, which is payable by the merchant to the acquiring bank shall be payable for such digital payment options to improve digital payment penetration. Now, accordingly, the Finance Act 2019 amended the Income Tax Act as well as the Payments and Settlements Act to enforce this provision in the budget. And Rule 119AA of the income tax rules provides for this prescribed electronic modes, that is the RuPay debit card, the Bhim UPI app, and the UPI QR code. Now, therefore, what was the impact of this change? The impact was that PAs and PGs could not charge MDR from merchants processing payments using these modes of payment. Now, naturally, this caused revenue loss to various business models and affected the financial sustainability of many of the payments players. In turn, this affected the valuations of startups in this space, which in turn would naturally have consequences on the investment that the sector would attract, subsequent innovation, and therefore, but however, obviously, these are long-term effects which are not easily visible. So in the short run, such waiver or price control could have immediate consumer benefit at the cost of long-term market distortion, hurting competition and consumer welfare. Therefore, in this context, a question that ought to be asked is, should financial consumer protection regulations extend to price control or fee waiver? Or should such fees be left to be determined by market forces? Now, I just also want to pose a counter example. There may be certain cases where the regulator may want to reduce the charges. For example, if you take the international remittances, there is a genuine concern that the charges are too high. The question is, how should the regulator go about addressing this issue, which is clearly a consumer protection issue because the charges are going to directly impact the consumers. If you look at the UK Payment Services regulations of 2017, they have a provision which requires the charges to be proportionate to the costs incurred. Now, that's a general principle, which you may say is a regulation on charges, but at the same time, it is not actually waiving of charges or controlling prices as we understand from the MDR example. Again, these are questions that we could discuss later. The next issue is how to address payment market concentration. This because, as we all know, concentration of risks is a unique problem in payments given the network's effect. In 2016, the Wattal committee set up by Ministry of Finance identified this issue, and it suggested that the NPCI shareholding should be diversified to include non-banks, because NPCI is the sole player in this market. So it suggested that NPCI be classified as a critical payment infrastructure company, and no legal restriction should be imposed on how many CPICs or critical payment infrastructure companies are there in the market. And this was proposed to be in retail payments so as to reduce concentration of risks. Now, in 2020, RBI invited applications for a new umbrella entity, which are essentially the same as the CPIC for retail payments. Now, this was a great approach to address the issue of concentration of risk by enhancing competition. Now, contrast this approach with the approach being taken to address concentration risk for UPIs, for third-party apps within the UPI system. Now, this graph gives you a sense of the fact that two players in the UPI system had garnered a lot of market share, around 40% over the last 5 years. Now, this was deemed to be a concentration issue, and that led to the NPCI issuing the volume cap circular, where it required the payments players to ensure that total volume of transactions through third-party apps shall not exceed 30% of the overall volume of UPI transactions during preceding 3 months on rolling basis. Subsequently, there was a standard operating procedure also brought in with the detailed provision. Now, the question that this raises is whether such ex-ante caps on market share is the most appropriate way of addressing concentration in payments market, and how does it really affect innovation and consumer choice? And the second related question is, are NUEs supposed to play the role of a secondary regulator? If so, what is the role of RBI, the primary regulator, and what is the role of the secondary regulator? Now, these are issues that we have seen in the securities market between SEBI and the stock exchanges. We have seen in insolvency market between the IBPI, that is the insolvency regulator, and the IPAs, that is the insolvency professional agencies. So there needs to be more clarity in terms of this two-tier regulatory structure, which is certainly a very sophisticated regulatory structure, but currently there may be some clarity which is lacking in the ecosystem. The next issue is, how do we improve consumer redressal? Now, there are a lot of issues concerned here, and I just wanted to focus on ODR, that is the online dispute resolution mechanism. In August 2020, RBI became the first payments regulator globally to formally adopt ODR. And that has been a fantastic move by RBI. It essentially requires the payment system operators and the payment system participants to put in place an ODR system for consumer grievance redressal of failed transactions. Now, subsequently, in October 2020, after actually RBI had made the recommendation, Niti Aayog expert committee chaired by Justice Sikri actually pushed for ODR in the judiciary and has recommended suitable legislative changes. Most importantly, it has encouraged the private sector ODR solutions, co-opting private sector providers. And another interesting feature is that everyone agrees that consumer disputes are the most likely disputes to be resolved by ODR, given the nature of the disputes, the need for efficiency, and the reduced legal costs necessary for consumer disputes. The Niti Aayog report actually mentions some international examples of private ODR service providers, and I've just mentioned some of them. So PayPal and eBay, these are payments and e-commerce players that the Niti Aayog report considers as pioneers in the in-house technology solutions for consumer dispute resolution. There are several other European and American and Canadian, Australian profit as well as non-profit based institutions which are handling consumer disputes across various sectors. So the questions that we probably need to consider in this context, in the context of payments, is first of all, should payment system players which are required to have ODR under the regulations be allowed to outsource ODR management to private players? And second is whether how could India develop the private market for ODR in India? The third is obviously with ODR, there will be an issue of digital divide, and therefore special care needs to be taken to ensure that ODR is accessible in rural areas and especially to vulnerable sections, also across the gender line. There are two other issues that I wanted to also point out. One is that RBI has been pushing for NEFT and RTGS to be operational 24/7. This has been a fundamental game changer. Now, the natural next step would be to expect that consumer grievance redressal should also be made operational 24/7. I believe everyone agrees this is desirable, but are there any challenges? If so, maybe it would be useful if the panel could highlight what are the potential challenges. The last issue I wanted to point out is with the entry of big tech in finance, this may create some novel consumer protection issues. For those who are following the Wirecard scandal in Germany and the Greensill Bank insolvency in UK, both of these were instances where technology or fintech players acquired a banking license, and subsequently this is what seems to have led to problems of merging commerce with banking. Now, in the Indian context, this was an issue that was recently raised by a RBI working group, and there was a spirited debate. Maybe this is an issue that will gain more relevance with big tech getting into finance. Now, with that, I will just summarize the issues that I have raised in this slide, and obviously these are non-exhaustive, and other issues would be raised by the other panelists. Thank you. Over to Dr. Krishnan.
Thank you. Thank you so much, Pratik. It was excellent, comprehensive, and yet entirely within the time allocated. I want to thank you on behalf of NCAER and all of my panelists and chairman present here. We look forward to very useful, interesting discussions on this. It's now my privilege to call upon my former colleague from the Ministry of Finance, Ravi Shankar, Deputy Governor RBI. Many of you, it may come as a surprise to you that the RBI has a lot of officers. I won't say a lot. Some officers who come on secondment to the Government of India. Ravi and I had the privilege of working together when he was with us in the Ministry of Finance, working on issues relating to the Public Debt Management Middle Office. This was over a decade ago. Ravi joined the RBI, and I'll make it very brief, Ravi. It's a very distinguished career, but I'll try and summarize it in 1.5, maybe 1 minute. Ravi joined RBI in 1990 and has worked in various positions in the RBI. His areas of interest and expertise in the RBI domain include exchange rate management, reserves and portfolio management, public debt management, regulation and surveillance of financial markets, payment systems and IT infrastructure. He has served as an IMF consultant on developing government bond markets and debt management. He has represented RBI in many international forums like the BIS, the Bank for International Settlements, and has also been a member of various internal and external expert committees and working groups. Ravi holds a master's in philosophy in economics, an MPhil in economics from JNU, New Delhi. Over to you, Ravi. This is just an initial introductory set of remarks, after which the panelists will speak, and I will introduce each panelist as we go along, and we will come back to you after the Q&A for the chairman's concluding remarks. Thank you. Over to you, Ravi.
Thank you, Dr. Krishnan, Professor Bhide, Mr. Dwivedi, distinguished panelists, and all participants. In fact, that was a very nice presentation. And before that, Dr. Krishnan himself sort of very briefly, pointed out many of the things that have been done in the area of customer education and customer protection relating to payment systems. That sort of substantially reduces my, workload in so far as I was trying to give you a brief idea of the things that have been done. I've also, it is indeed a little bit gratifying to see that in the presentation, especially, it comes out that RBI has taken a lot of novel steps in the area that we are discussing today. Some of them not been taken anywhere else. Some that were not mentioned we are doing are things that have not been done anywhere else. For example, we are working out something like a digital payment index, to identify geographies where, with mature or immature or, somewhere in the middle in terms of digitization of payments and so on. So it's gratifying that RBI is working, that the market is, our RBI's steps are being taken positively in the market. I will give a very, very brief introduction. I understand, the time constraints, but before I do that, I just thought I would, set aside one point. In the interest of free debate, let me clarify that what we speak, me or the other panelists, while it would obviously reflect our, background and our work experience, and in some sense, the organizations that we all work for, these should not be taken as reflecting the official views of the respective organizations. I think in the interest of a free and frank debate, that is something that I would expect all participants to respect. Briefly, I will just set the tone for what, for the substantive discussion of issues by the participants. Just a bit of background. Payments, along with deposit taking and credit creation, is one of the three fundamental banking functions. It is easy to get carried away with all the talk about cards, wallets, gateways, and aggregators, and so on. But it would help to remember that all non-cash payments are essentially a transfer of money from one bank account to another bank account. So all digital innovations are, in a sense, digital payment innovations are, in a sense, banking innovations, in that they all revolve around payments that finally happen through banks. It is, if you come to think about it, it is actually not so difficult, if you are willing to have an open mind, to conceptualize UPI. We all know how UPI works. but one could also conceptualize UPI, the premier innovation of our times, to function just as effectively if it involved only banks and no one else. It is possible. So this bit of, this bit of unexpected advice is my way of telling you that attempts to view delivery solutions, customer experience, and regulations in the payment space distinctly from other banking functions such as lending is likely to lead to suboptimal solutions. For all payments issues, therefore, this means talk of replacing banks, for example, you would read many articles if you think about neo-banking and so on. Talk of replacing banks is at best premature. There is yet, having said all this, there is no doubt that the face of banking, the face of delivery of banking services has changed immensely in the last decade or so. To be sure, there are important corollary services, largely in the area of communications and processing of information, where technology can be leveraged and technology is being leveraged. That has helped in democratizing finance by extending access and reducing the cost of access in ways unimaginable, till a few years back. The objective of this session that we will have, that we have coming up, is to discuss if such access is being extended with the best interests of the consumer in mind by the service providing industry, what we may generally refer to as payment service providers, and by policymakers, regulators, governments, and everyone. Are consumers aware of the services on offer? Do they understand the risks in using the associated technology? These are issues in consumer education. Are they being reasonably charged for services? Is their constitutional right to privacy being scrupulously ensured by all agencies? Are they being deprived by other agencies of the monetary value of their information? This is an issue that doesn't get discussed very much. Does the system provide consumers with the mechanism to protect their interests ex ante and provide redressal options ex post? These are some of the questions that our carefully curated panel, and there are other questions, those 5 questions that Dr. Krishnan has raised and the issues Pratik has highlighted. These would be what would be discussed by our carefully curated panel. Thanks to Dr. Krishnan. It's a beautiful, very, very, very highly knowledgeable panel, eminent in their respective fields. They will try to discuss. If Dr. Krishnan permits me, I would start off the debate by asking Samir Nigam, founder of PhonePe, to talk, obviously understands the issues, talk about the issues relevant from his point of view, but it would be, I would request him, if time permits, for him to focus on the role of large service providers in educating customers, key to developing the catchment area for business, in fact, if you think about it, and consumer protection. And secondly, a bit about the role of pricing and the nature of pricing in ensuring consumer protection. Over to you, Mr. Nigam.
Ravi, just
yes,
for 1 minute to introduce Samir fully, if you permit.
Yes, yes, please.
Samir is the founder of a UPI-based online payment system, PhonePe. All of you know him better than I, which was founded in December 2015. In 2016, PhonePe was acquired by Flipkart to expand their online shopping footprint in the country. Samir continues to lead PhonePe as its CEO. Prior to that, he had founded a social media distribution channel called mime360.com, which was also later acquired by Flipkart. Samir completed his undergrad degree in computer engineering from University of Mumbai. After that, he went to the University of Arizona for an MS in computer sciences, and then went to Wharton for an MBA in entrepreneurship program. He certainly is one person who has lived what he has studied. Over to you, Samir. Look forward to your presentation. Thank you.
Thank you so much, sir. Really appreciate the opportunity to be here. Just looking at the time, I'm just going to dive right into it. So, given the topic around consumer protection, consumer education, I thought I'll start by first talking about why I believe digital payments is much better than the alternative, which is cash, across the three key stakeholders, which is consumers, the BFSI sector, and broader industry, and then government, and then actually explain my point of view on each of these. I think from a consumer standpoint, and I consider myself one, I think the minute transactions go digital, payments go digital, there's more traceability. By definition, things are more traceable. And when things are more traceable, ultimately, end-to-end fraud should come down. I genuinely believe technology prevails. Topic for another day, but this is one of the big reasons why I don't like unregulated crypto and I don't like cash. I think the second thing that really happens is when there's so much of a data footprint, I think the technology industry is able to build much better risk and fraud management systems, which means you can actually preemptively build much better take much more preventative actions. You can prevent social engineering frauds. You can blacklist merchants that are committing regular fraud. There's so much more you can do at source as opposed to after the event. And finally, I think at a consumer level, and this is very true in India, given the diversity, I think it is imperative that we actually create respectfully, but create rich data profiles that will allow us to create the right type of products for the market in India. I always cite this example. When I moved back from the US, I'd been working for 10 years. I was not able to get a credit card from the top 3 private banks, one after the other, because they didn't have a credit file on me. But the minute I showed them a dollar statement, I was able to get whatever I want. Now, when I think about that, and I think about where we are at 10 years later, I think the same reality is still true in a lot of the hinterland in India, where digital data profiles are not available. And I think this is perhaps the biggest gain we could societally get if digital payments became all pervasive, and we can get a lot of data for consumers and help them. So in many ways, to me, digital payments, when I take a technology sort of view, there's mobility, there's telephony, there's search. Payments is a ubiquitous layer in the tech infrastructure, and it's really the gateway to both financial inclusion and commerce in many ways. So this is why I think worldwide, the technology industry, a lot of us in the industry, have really sort of started focusing on payments and unlocking digital payments at scale. Which takes us to, I think, the banking and financial sector as well as the e-commerce sector. Acquiring consumers for something as staples as payments is like acquiring them for something as staples as communication or social media. There's a very attractive economies of scale that comes in when people are doing digital payments at scale. It also poses a bunch of problems, and we'll come to that in a minute. But when you have this much data, you can also have a positive virtuous effect by having much better targeting and keeping those same customers engaged. It's not an infrequent transaction. So on PhonePe, for example, we see over 100 million users every month, and they come 30 to 40 times a month. It's a very, very different level of interaction than what I saw in my past stint at a Flipkart, where people shop online maybe 4 or 5 times a month, and that's during a pandemic. And I think the third, which is critical for the financial inclusion vision, I think is the fact that when you go fully digital with payments, the rest of the financial services follow. Now, this is already proven out in various geographies. Paperwork is slow, agents are expensive, and in a market as big as India, digital payments and the data trail it creates will allow for proliferation of small ticket, massy financial products to follow. I think the third key stakeholder, obviously, on the policy side, the government and the regulators. I think when there's that much more transparency around how money is moving, especially with the merchants, there's an expectation that the tax collections will grow in the country. There's equally an expectation that a fully connected India will allow for much more efficient usage of subsidy money. And the DBT program is a fantastic example of that. It's public-private collaboration at best. And finally is in terms of larger reach, right? Can digital payments reach 1 billion people, and thereby can we start finally delivering on financial inclusion at scale? So I think from all these angles, I think India is at the precipice of something remarkable. I think we have by far and away the best technology infrastructure that one could ever expect in terms of sort of public goods worldwide. Take a lot of pride in being in this industry where we have regulators as well as the government investing behind things like GST, Aadhaar-enabled payments, UPI, interoperable QRs. So I think wanted to start there on a positive note because I think we lose sight of how fast things are developing here. And sitting at the industry side, we make most of the noise asking for more every day. But that's the nature of the beast. We are both the disruptors and the innovators in a sense. So we will always ask for more. But I think this discussion is a lot more about where we are at and what we can do. So coming from there, let's look at the barriers to growth. If digital payments is great for the consumer, the market, and the government, let's look at the consumer side challenges. I think on the education side, what we see is we have a lot more to do in terms of understanding how to engage with customers on the localization aspect, especially on customer service issues. But one of the myths, at least I think it's a myth, is that people want apps in multiple languages. We launched PhonePe with a lot of pride. We've had a team for the last 6 years. We launched in 10 languages in 2016. And till date, the adoption of localized content for using or doing transactions or using the app is 10% or less. However, the customer service chatbot as well as the helpline regularly see anywhere between 50 to 60% of calls in regional languages. And when we talk to customers, what we hear is the apps they have learned because they're simple transactional elements. Payments is, in fact, reasonably easy to understand, familiarity builds in. But when they have issues for redressal, they feel much more comfortable speaking in their local language. I think there's a lot more work we need to do. I think there's a lot of natural language processing we need to learn how to do. There's a lot of agents we need to train. And that's work ongoing. I think that's a clear area of improvement purely on the industry side. On the redressal mechanism, I would actually contend that, again, I think we have one of the most progressive public-private collaboration schemes in the country, if not the world, on digital payments. Examples of those are platforms like CyberSafe. CyberSafe equivalents did not exist in the cash era, but CyberSafe and the EFCON initiative, we are very proud participants in that. I think is a fantastic innovation where law enforcement agencies across the country, from the smallest police station to the largest players, are able to collate data and make it available to all the ecosystem partners. Then there are redressal mechanisms like the RBI Ombudsman program. Again, in its nascency, I think a lot more needs to be done by the industry players to create awareness of it. But I think the program has legs and is starting to show value. There's the UPI UDIR. I think for me, the biggest open question that everyone keeps talking about is who bears the ultimate liability when it comes to consumer protection if there is fraud. This is a big debate. And I think here there is a challenge between the government proposed model of zero MDR and digital payments being a public goods and the industry fueled investor backed model, which necessitates that you should follow at best an asymptotic curve, but there needs to be some financial incentive and some revenue and earning before you can talk about taking on liability, which is financial in nature. This is a big dilemma we need to answer as a country. I think the second one, and Prateek touched upon it, is the ex-ante market caps. And I say that with a smile because I'm right in the middle of that. I think one thing he failed to bring out was that while two players in the market today have more than 40% market cap, if you look back over the last 4 years, pretty much every passing year, there's been different people in the top 3 or 4. I think to me, between not being able to charge at all on both the consumer and the merchant leg, as well as having a looming 30% market cap, I think we have a real risk of the UPI system becoming very unattractive for the private sector. And I mean the non-banking sector in this one. One, I think, easy way to figure out the early signs is not to look at how much the market is growing, but how many market participants are entering. When we launched UPI, 30, 40 banks had launched the UPI apps. Then the government launched an app called the Main UPI app. Then all the private players came in. Today, as things stand, I would contend, I believe rather, since UPI zero MDR law came in, I think there's less than a dozen new participants, and there were almost 200 participants in the first 3 years. So that's the first clear signal that the market is unattractive. And the last point I would land is that if the government and the policy is pushing us in the direction of fintechs and payments, gathering data and then delivering on financial inclusion, then the licensing regime needs to change. One of the two has to happen. And I'm old enough to actually say that I think regulation of the tech industry is very important. I actually think that they need to be regulated to operate in this sphere because you're touching money. These are not jokes and tweets. But I think the regulation should be focused on governance and data localization and data protection, not on shaping the market participation and incentives. With that, I'll stop. Sorry, KB sir. I know I ran over time.
Just marginally. Thank you so much, Samir. Ravi, if you permit, I'll quickly introduce Srikanth, and then you can guide him in terms of your own expectations. Is that fine?
Yes, sir. I think since we have, since they know what they need to speak, I think you can introduce, they can talk, and then we can take, henceforth we can do that.
Fine. Thank you. Thanks, Ravi. Thank you again, Samir. Srikanth, our next speaker, Srikanth Lakshmanan, is a software professional by occupation with interests in free software, open data, technology policy, data economy, among other things. He coordinates activities at Cashless Consumer and also independently researches and writes on large-scale technology interventions as part of Karana, a community collective that started looking at Aadhaar from a technology lens and has since evolved into a civil society space around broader areas of digital governance, cyber security, and technology policy. Over to you, Srikanth. Look forward to your presentation, focusing much more on the consumer side of this conversation. Srikanth, you're muted.
Yes, sir. Sorry. Yeah.
Thank you.
Yeah, I would like to thank the chair, Professor Krishnan and NCAER for giving me the opportunity to share my thoughts before this distinguished audience. It is a welcome effort to seek feedback on National Strategy for Financial Education 2020 to 2025 and discuss consumer education and protection issues in payments and settlement systems. To truly achieve the goal of a financially aware and empowered India, it is important for consumers and civil society organizations to build upon the basic financial education, process education developed by NSFE and develop a body of independent knowledge base based on 6th C, what I call as critical thinking. This critical thinking ranges from the smallest of actions on a consumer, such as clicking a payment link from an SMS or accepting a payment request, or choosing to use various features of payment apps, or deciding to use the right payment instrument, or being able to critically think on proposed regulations and provide valuable feedback for the ecosystem and regulators for an overall balanced growth while mitigating consumer harms. I would like to humbly place to this forum that there are problems in including financial attitude as part of financial literacy measurement, as it is for the consumer to decide when to use which financial instrument using an independent assessment, prioritizing consumer interest. Awareness initiatives such as RBI says National Digital Literacy Mission have done a lot to increase consumer awareness. We still have a long way to go, though, in terms of safeguarding consumer interests from rogue actors and cyber criminals. More creative ways of embedding consumer education into design of payment systems and processes is needed to make aware of consumer aware of and safeguard them from frauds. Preventive controls such as the default control on cards mandated by RBI, giving choice and control to consumer, needs to be widened to every payment system. While it is laudable for the Ministry of Home Affairs to have announced a fraud reporting hotline, there needs to be a sustained and increased capacity in cyber policing, cyber law enforcement, be it combating the small-scale fraudsters or large-scale cyber attacks. And financial regulators must support law enforcement, both operationally as well as financially, I would like to suggest that a new fund to support law enforcement agencies be created by the RBI and be funded proportionally by the payment systems. This places directly a monetary responsibility on the part of payment system operators and payment system providers to enhance security in payment system processes and mitigates the moral harm of offloading costs to law enforcement agencies. There is a need for consumer information gateway for faster access to authentic information in a rapidly evolving landscape. It is increasingly becoming difficult for consumers to access information on pricing, processes, consumer grievance redress mechanism, and so on. As more and more autonomy is given to regulated entities in the form of having board-approved policies, there needs to be an effort spearheaded by the regulator to organize information for consumers' easy access. While RBI has progressed in many areas of regulation making since its descent to draft PSS Bill 2018, such as increased consultative approach to regulation making, releasing more payment systems data, there is still room for improvements. One specific recommendation I would have in this aspect is to formalize the Section 86 of the draft PSS Bill, which democratizes the ability to suggest changes to regulation and places a mandate on a regulator to accept applications for change in regulation. Such an institutional mechanism to review regulations can empower to suggest regulatory changes to mitigate harms and overcomes regulatory bandwidth issues by broadening the regulation making base. There needs to be a forum that is ongoing to have policy level conversations on payment system design and security. This is essential to fix payment system design issues, which are root causes of consumer protection issues, be it fraud or grievances early on in the cycle. So we kind of get to save a lot more on the grievances pretty early on in the cycle. On the issue of private ODR and new umbrella entities, I feel that there needs to be a clear separation of payment system design designated for social policy objectives of the government and those by the market providing value addition services to consumers. Both are all things related to pricing, regulation, ownership, grievance redress have to be different for both of these distinctly separate set of payment systems. And there needs to be a distinction on payment systems designed for social policy objectives of the government and those that are providing value addition to consumers. On the issue of proportionality and data, I feel that there seems to be a disproportionate amount of data taken from consumers while not returning the benefits of data in data terms to consumers back. There is an active need for adversarial data from the regulator, payment system operators, and payment system providers. Some of this have been solved through the Right to Information Act on the statutory authorities. But RTA in practice gives a mixed experience. It's still better for consumer organizations like us to access adversarial data. There also needs to be a way to suggest changes to payment system design such that the constitutionally guaranteed fundamental right to privacy exists. And this could be solved in two ways, as either by creating laws such that it passes the Puttaswamy test, or to modify the design of payment system itself to build in privacy protections. And yeah, that is all I have. Yeah.
Thank you. Thank you so much, Srikanth. Appreciate your very concise yet focused intervention on the consumer side of this conversation. Thank you very much. It is now my privilege to call upon Naveen Surya, who is a distinguished name in the digital and retail payment system and fintech industry in the country. He's Chairman Emeritus of the Payments Council of India, PCI. Additionally, He is a member of the Innovation Council of the NPCI, the National Payment Corporation of India. He is non-executive director of a greenfield housing finance company and is also advisor of Mitsui & Company Limited, Tokyo, Japan. His earlier stints include working as a management consultant with TCS and a leadership role with IDS Cash Card Limited, India's first ever multi-purpose prepaid cash card. Over the last 2 decades, he has undertaken many pioneering activities, some of which are a key foundation for a digital economy like the cashless trade exchange, India's first digital wallet for the masses. Over a period of time, he's been a part of many committees, all of which, Navinji, I'm not going to name. There are lots of them, including the committee that was chaired by Dr. Ratan Vatal. He is a management graduate with specialization in finance. He is also an associate member of the Company Secretaries Institute, besides being a graduate degree holder in both commerce and law. Over to you, Naveenji. And if I understood you right, you will be doing a PPT.
Yes, sir.
Thank you.
So the reason of doing PPT, sir, was that we also have a document, since we are representing the association, to have an ongoing dialogue. I may not cover all the points there, but idea is to highlight some of the points. And in interest of time, I'm just jumping right into it. So broadly, I'll be covering about 4 key points. One, how does the RBI's vision statement itself has completely centered elements around customer protection, and how in such a short period of time, this industry has achieved remarkable feats, remarkable achievements, and still taking consumer, let's say, protection at the heart. We're going to talk about, as Pratik also asked, that do we have adequate policy and a regulation for consumer protection in the payment systems. We're also going to talk about what an industry role could be, what they have been doing, what could be done better, and that's where probably we will take even NCFE's offer to work more closely and achieve the objectives of consumer education as well as protection. And we'll also be talking about what are some ideas that we could help implement, just as a suggestion, and some other points which Pratik had highlighted, some of those questions. So fundamentally, sir, we are all focused ultimately on driving a less cash economy and focusing on, as RBI vision states, that how do we empower exceptional e-payment experience for everybody in the country. And if you look at the vision itself, it very clearly focuses on elements like access, which is seamless choice for everybody to own a payment option, which is digital. Safety and security has always been a hallmark. I think every time a new regulation comes, we remember the number of discussion debate we have, whether it's safe for the customer and how secure is the process. And the challenge always is that how do you now balance safety, security along with convenience, quick, and the finally affordable. Of course, affordable, as Samir has already made some point that here in this case, it's not just affordable, it's free in many cases. So we're going to talk about that. I would just highlight that, which probably has not been talked so far, that the industry is about just 2 decades old. The first decade was largely without the regulation. It's only the Payment and Settlement System Act, which actually came in 2007 as a bill, eventually started getting implemented from 2011 onwards, with multiple guidelines for the sector, opening up the sector for non-bank. But if you see today in such a short period of time, it's the fastest growing, and it has created a very large ecosystem, and probably across the BFSI segment, this would be undisputed leader in terms of innovation and the speed. I think over 160 entities are licensed, both bank and non-bank. That's the size of the ecosystem who are licensed and working actively to drive agenda of less cash. I think in such a short period of about 20 years, the paper transactions in a retail has already been reduced to kind of less than 10%, which were dominant. We have already covered population to the extent of 20%. So probably next to banking, this will be the sector of a payment which has the largest coverage within financial services. And this is again the only area where, in terms of innovation, in terms of products, in terms of, let's say, many other parameters, now today India is seen as a world leader, and especially in the fast payments. Also, this has been the most attractive segment from an FDI perspective. Of course, zero MDR issues has dented that bit in the last 2 years. And if you look at all the growth rates in terms of volume, they would vary between very high 2 digits like 60, 70% to even 100% plus in few years. And then if you look at the values, very high 2-digit values like 40 to 60% in various products. So extremely fast growing, very less time, but a lot of things have happened. We have I wanted to kind of balance this growth with the customer centricity in mind, whatever has happened. So the first question that Pratik has also passed and all of us also reviewed, that whether we have adequate regulation to have the sector. Now, fundamentally, I break what needs to happen in a consumer protection. One is that everything to do with consumer money, whether that's taken care of. Second is all about qualitative aspects about their experience in dealing with payment entities. So as far as it concerns to the fund, I think that has been a remarkable job. I don't think consumers have lost money with an entity due to bankruptcy or have lost money due to disputes. Yeah, there are some stray cases of fraud, but even there, the mechanism at least exists for them to get the money back if they've done the, let's say, process right. It may take some time. In terms of appropriateness of fees and charges, I think the affordability has been hallmark. Most of the services, in fact, today are free. So it's actually extreme view there. On the other hand, what we are looking at is the service quality now, because the fundamental pillars are already in place. All the policies for each of these aspects is in place. In terms of complexities that is growing within the payment and the speed it is growing, I think we need to work a lot along with the players, other players, that how do we deliver a right information, which even Srikanth mentioned, that what is the right product for which customers, what are the fair terms, what they all need to know about using those products. And most importantly, as the ecosystem of a front end, back end, different entities, license holders, non-license holders, fintechs, working together, while they all sign different SLAs amongst themselves for their working between themselves, are they following? So we need a mechanism to monitor and control the different service levels that are being identified between them. Are they being really adhered to? Similarly, the turnaround times, which are clearly prescribed by RBI and various policies or by the board approved policies, but probably better mechanism of, let's say, focusing on achieving those turnaround times by individual entities. So SLAs and TATs play hand in hand, and we need to identify them and stitch them together in a right way. So I believe now is the time to move from a model, which I think we had a very nice tree under Payment and Settlement Systems Act. A lot of birds have come, put the nest, is doing well, but probably because of the complexities increasing, we need to work more like a beehive now, very closely, where customer does not have a concern that if they're dealing on a touch point where they can buy products or consume service, they should also be able to get the resolution of all their services or all their disputes. So that's where probably we need to move. And again, a lot more work we all have to do together on the service quality side. As far as industry role is concerned, I think industry focus, since these were the formative and early evolution area time, a lot more focus has been on supporting policies to make sure that the industry evolves on a solid foundation. So we've always been supportive for rules like escrow, which was put in place for PPIs. In fact, even when in the industry, first time somebody talks about should we dilute or ask for a dilution escrow, the industry would always say no, because I think it's a right pillar to make sure that the customer 100% money is 100% safe and kept separate. So a lot of these pillars on the policy side, I think industry group at a PCI, which represent 90% plus digital payment players, kind of have been doing a lot of work, and that has been going well. Probably what we need to work, looking at the increased complexity, is on the communication and a customer side. So whether it is facilitating dissemination of, let's say, product related information, what role we could play more, I think we would like to focus on that. Even monitoring the overall effectiveness and affordability, so that there is a balance that if it is already affordable, then it is not driven to a non-sustainable part of it being free. So somewhere a balance is drawn, so we are happy to work on. And create a regular continuous feedback loop from a product introduction to a kind of delivery mode to the dispute resolutions. And work so far, the industry has been focused on working on these parameters on slightly event-based or reactive basis. For an example, during demon period, there has been extensive campaign and a special helpline created by the industry, which saw even at the peak some 600,000 calls, both from a potential merchants or end customer, to understand how to use payment services for the first time. So a lot of these initiatives were done. The work is in progress with RBI, and now we can even talk to other agencies here to see that how we can structure it better. And that's the area we believe that we will start focusing on, and we are again willing to work together on that. Some of the other suggestions that I think this is just a borrowed paper from the same overall strategy of an SFE to kind of drive the financial education. We believe that the same thing needs to be done for payment sector, and we as an industry are happy to play a very active role. I wouldn't go through all the points, but one suggestion that I wanted to highlight was around how do we utilize very skilled MBA colleges and their students to involve directly in dissemination of information and education of financial services. While we have a lot of other ecosystem involved, but there are 600,000 plus MBA students. and there are 160 PSOs, if we align with different banks with different PSOs, basis their capacities, and create a map of block level dissemination of information through these students, and these students are then given special credits and a special preference for them to be absorbed in a fintech sector. Probably we could develop a model like this, which could additionally help drive these immediate or a most critical aspect, which is education. But that is what actually also causes in most cases some sort of a fraud or some sort of a risk to customers. So this is just the broad suggestion here, and we are happy to take it forward in a further discussion. Some of the other points just to highlight, I think in terms of bundled offering, we've seen some cases where while the core service of a wallet comes free, but then a bank account is bundled with it. So how do we make sure that such information is transparently provided to customer? Because sometimes he will feel that, okay, I signed up for something else, but here there are 20 other services that have come, I've not asked, and now after a year I'll be charged for that. So yes, we have to work on that better offering and making sure that transparently communicated. Similarly, the fundamental point about the whole complex set of a converged rule in a converged economy, where the services of multiple products will happen from one platform. How do we make sure that each of those delivery points are not just the selling point, but also a customer service point? That convergence we have to create at the back end by designing appropriate roles of every player in the ecosystem, whether done by the same entity or different entities, but different activities, different roles, SLAs, TATs are defined. And of course, I would like to re-highlight the point that Samir made, that somewhere we have to balance between what's affordable and what's free, not leading to a, let's say, value creation loss and challenges for the industry in terms of long-term objectives and sustainability. And of course, I would second having from a long-term perspective, a kind of unique financial sector focused both consumer protection and a data privacy law, which probably can also be a championing for all other sectors, and payments can lead it because it's quite complex already. So I'll stop there, sir. I hope I was on time.
Thank you. Thank you so much, Naveen. This is a very balanced, I would say, responsive and responsible presentation. It's not easy to head a consumer, I mean, an industry body, which is almost a self-regulating organization, and yet balance the competing, often competing needs of the consumers and the producers of services. I want to thank you for that. It's now my privilege to call upon Malavika Raghavan, a lawyer working on emerging issues for policy and regulation at the intersection of technology, finance, and inclusion. She was till recently the head of Future of Finance Initiative at Dwara Research, where her work addressed new challenges for consumer protection in India. She remains an advisor on the initiative's International Advisory Board and also serves on the steering committees of the Digital Identity Research Initiative at the Indian School of Business and the Data Governance Network at the IDFC Institute, India. Malavika's previous experience includes several years with the global law firm Allen and Overy LLP in London, but more importantly, during which time she was seconded to the Financial Markets Law Committee established by the Bank of England, the central bank there, and stints with social impact investors, Acumen and Big Society Capital. She was a 2018 fellow of the Chevening Financial Services Fellowship at King's College, London, and a 2016 fellow of the On Purpose Social Enterprise Leadership Program. Malavika holds an MPhil in Public Policy from the University of Cambridge, a composite 5-year law degree from the NALSAR, National Academy of Legal Studies and Research at Hyderabad, and I believe soon will begin a PhD at the LSE, London School of Economics, from September 2021, working on information systems and law. Over to you, Malavika. And like Srikanth, I guess your focus will be on the consumer side.
Yes, thank you so much, Professor Krishnan, and thank you to this august audience for hearing me out. I know at this stage in the presentation, saturation might be reached, so I'll try and make my comments as conversational as possible. As Dr. Krishnan mentioned, yes, I'd like to bring the focus back to consumers. And I think basically start my comments by painting a picture for you in terms of how on the ground, things have changed for the consumer over the last 10 years when it comes to making a simple payment transaction, and really use that to pick up on two boundary issues that for consumer protection amongst all the very many ones that we've discussed, in order to lead us into the second part of what I want to talk about, which is really solutions at both the policy and the industry level to achieve the consumer outcomes that we all seem to be pretty aligned on this morning. As a kind of sneak peek, I think those solutions are very tied into fundamental principles of functional regulation in the financial sector, and what the Deputy Governor mentioned up front, which is the role of the central bank and how how the policy response really needs to be calibrated, giving these two things in mind. But those are just my recommendations as a consumer advocate. So to go back to that picture I mentioned, obviously when it was just a cash transaction, when you had a consumer who wanted to settle accounts with a friend or pay a retailer, essentially they were able to do that through this physical cash that was intermediated through the banking system and turned up in their hands. Now, what has changed over the last couple of decades that all of you know much better than me possibly, is that you've had a range of interfaces that now intermediate that transaction between the consumer and the other person. So that two-party transaction now has this interface in between. And that online interface that the consumer encounters when they make a payment, many consumers, those who have smartphones, who are urban, and the NCFE survey tells you that already the ones who can access this interface are those who are above the digital divide, so to speak. But what then happens is that consumers' first interaction with the financial system in a payment transaction is often with an entity that could be an online app. It could be a PPI or a prepaid instrument wallet. It could be a payment gateway on a website, for instance. And what the consumer doesn't know is that you also have, for instance, several other types of entities, an authenticating agency, all of the card networks, so on and so forth. Now, the reason I'm placing the landscape that we all are engaged with at some level in front of us today is that I think it reveals one thing in particular when you compare scenario A, which is a simple kind of old world cash transaction, and scenario B, which we're all in together, which is this kind of online digital transaction for payments. And one thing it shows you is that the range of actors in this bilateral transaction has increased vastly. You now have a new class of actors, often the first point of interface for a consumer in a payment transaction, who may be outside of the regulatory perimeter of the RBI, might not be a financial sector regulated entity. And they are essentially sort of disintermediating the flow of money in the economy that is traditionally intermediated by banks. And this is, opens up a range of questions that, of course, Pratik went through in his presentation. But I think at the highest level, this is a structural change in the payments landscape that we're all grappling with. And therefore, for my remainder of my comments, I'd like to maybe focus on the structural solutions, while no doubt saying that consumer literacy, for instance, is important. But many of these changes in the back end of finance are not some things that, perhaps the consumer even needs to know about. You need to know how to drive a car, not necessarily how the engine works, in order to agree every moment you're in that car. And how do we get ourselves that kind of structural consumer protection? The two particular issues that I wanted to focus on in the second part of my comments was just what this picture unrolls. And we already started talking about the first part of that, which is the consumer-facing entity, perhaps being one that's outside the RBI's regulatory perimeter, which goes to one of the questions Dr. Krishnan raised in terms of should the RBI even be concerned about tech firms and regulating them? Now, I think, there are various answers to this complex question, of course, but I think the essential thing from a consumer protection perspective is the objective for the regulator and for the industry, of course, and especially the regulated entity, is to ensure how do consumers get the same degree of financial protection that they would with a regulated entity outside when they are facing a non-regulated entity. Again, as we mentioned, at the end of the day, funds are moving from bank account to bank account. So the idea is, even if you're talking to an entity who is not in the regulatory perimeter, how are you assured the same level of consumer protection? I think one of the things that we haven't discussed yet, so I might just bring up, of course, frauds are one of the consumer concerns, but we also see a quite large degree of transaction failures. Now, these are not, in the end, the money is often returned to consumers, of course. But I think the important question here is, especially when we have a country where 77% of people earn less than 10,000 rupees a month, even with small value transactions, how do we ensure that when the money is lost in the system, according to them, that those costs are not externalized on the consumer, right? And how do we create a dynamic consumer redress sort of mechanism. And really, this will bring, we'll come back to this. How do we think about regulation in a way that extends financial consumer protection outside of just banks and NBFCs? Now, the second issue it brings up for me is that the boundaries, and this is very difficult for a regulator, the boundaries are very quickly disappearing between financial and non-financial activity. And even within financial activity, financial functions, say of payments and credit, that we have traditionally seen. And I think it's always helpful to lead with an example. So if you are on an e-commerce site, very quickly, you can be browsing for products that maybe you're thinking of buying around the house, which is essentially not a financial activity at all. But in a few clicks, you can be considering that product, paying for that product. And when you are paying, be offered to pay for it in EMI. And very quickly, the consumer has gone from window shopping to taking a loan, all on the same platform. Now, this is some of the exciting opportunity of living in a tech-enabled world, of course. I think what it raises, though, is how do we ensure that the payments data and the payments process that is collected from the consumer in this entire chain of events lives up to the customer outcomes that the RBI and certainly many of the industry players and consumer advocates in India do want. And I must say here, we'll come back to this. I'm sure it has come up already on the idea of payments data. One part of it is to protect that data, but I think the other clear business model in this economy is that payments data is then used to cross-sell or upsell products, whether they are especially financial products. So, the management of that data also has implications for financial inclusion, financial depth and width. And so I think essentially in this landscape, that's why I come back to this idea of how do we think about structurally about consumer protection, because what constitutes a fair or an unfair practice and results in an unsuitable, deceptive, or at the far end, a predatory or a discriminatory sale for a product may not be something that the consumer is necessarily aware of, even when you're talking about the interface. So really, and it becomes easier in some sense when you do have fairly responsible providers at the table as well. How can we have that conversation beforehand? And really, this is where I want to spend sort of 4 or 5 minutes to end, is when we think about the solutions here, I think they occur at 3 levels. And they occur because you have to start off thinking about what are the outcomes. And in this audience, what are the outcomes that we're looking for every Indian consumer, right? And I think suitability is at the heart of this. This right to suitability is enshrined in the RBI's Charter of Customer Rights. It's an instrument that already exists. Along with the right to suitability, you have a right to fair treatment, a right to transparency and fair and honest dealing, a right to privacy, and a right to grievance redress and compensation. So I'm reminding you of what many of you may already know. Financial institutions have to have a board-approved policy to give a rise to these rights. The issue is when you're defining suitability as ensuring that the product, in this case of payment, offered by an intermediary is matching the client's situation, their objectives, their risk tolerance, financial needs, knowledge, and experience. So these are the definitions that we have in law and other soft law instruments. And we tie that back to the RBI's own customer outcomes, which we have seen come out in the latest trends and progress on banking and finance. You do find that all of these objectives are the kind of North Star. You do want transparency, you want suitability, privacy, grievance redress. Having said that, how do we get there? And I think many solutions have been discussed in the course of this conversation. Do we need a separate act? Do we need a separate instrument, a separate agency? I think to start off, my response to that level of discussion is perhaps we do in the medium term. In the short term, we actually do have many instruments. And the question might be, how do we start doing better enforcement for consumers? So you do have a charter of customer rights. You have fair practices codes that apply in any way to banks and NBFCs. And the question is, are we doing enough on consumer protection already? And where there are third-party non-financial sector entities, how are we ensuring that the rights and these fair practices are passing through even into those service level agreements that Naveen brought up as well? And how do we guarantee this kind of non-deceptive, responsive payments process? I think from the RBI's perspective, there's also a need to think about functional regulation here. And the reason that I come back to this is, even though we want these customer outcomes to pass through to non-financial sector players, the question really becomes in my mind, at what point and at what function is that player undertaking? I think the whole idea of trying to give a license for every activity is going to very quickly unwind. And I'm aware that my time is ending. So I'll come to I would say the most important part of this conversation from my perspective is really talking about liability frameworks and risk frameworks and the overlap with other legal regimes. When I talk about liability frameworks, I think what I'm talking about here is how do we, not just monetarily, but how do you think about ex ante supervisory measures that the regulator can take in order to ensure that there's a feedback loop into the regulator's oversight of financial markets infrastructure and retail payment systems. I think this is important because at the micro level, you might be trying to ensure that a consumer is not missold. But at the macro level, this is a question about how do you regulate financial markets infrastructure. The overlap with personal data and privacy is a totally different conversation, I do. But I think most conversations about privacy ultimately are a conversation about trust, right? I just do a quick time check, Dr. Krishnan. Have I run out of time? Do I have a couple of minutes to wrap up on this?
You have maybe just one more minute.
Okay, I feel like I'm on a news channel, but very quickly, just on privacy, the Privacy Act that we're going to have has a lot of provisions around data portability, data minimization, purpose limitation, and so on. And so I think when we're coming back to functional regulation and the perimeter, there's a need for the RBI to act in consonance with other new regulators and the competition regulators, the data protection and the competition regulator, so that we come up with a harmonized law and we then can gold plate to the financial sector and don't go through the process that the US has, for instance, where they might have differing standards in differing sectors, which ultimately harms the consumer. So with that, I will pause and hand back over to Dr. Krishnan. Thank you.
Thank you. Thanks, Malavika. That is an interesting and useful connection between the different regulatory regimes that will necessarily need to intersect and different regulatory agencies that will necessarily need to work together to handle this complex issue, and all handled from a consumer point of view. I want to thank you for that. Now I call upon the concluding and perhaps the most important panelist on in the sense that the only panelist who's actually dealt with the intersection of the consumer and producer in this sphere. And it's my privilege to welcome Mr. V.G. Sekhar, Chief General Manager at RBI, and at present the Principal of the College of Agricultural Banking. Immediately prior to this current role, he served as the Banking Ombudsman and the Ombudsman for Digital Transactions in New Delhi. At RBI, Shekharji has had diverse experience in areas such as currency management, payment and settlement systems, banking supervision, cybersecurity, inclusive banking, capacity building, and consumer grievance redressal. He was a member of the internal committee of the RBI to review the ombudsman schemes. Some of the recent policy measures like adoption of one nation, one ombudsman approach and integration of the 3 ombudsman schemes and strengthening of the grievance redressal mechanism in banks were part of the recommendations of the committee that he was a member of and which have been accepted and acted upon by the RBI. He's also been a member in several other committees formed by the RBI on financial inclusion, information technology, etc. Over to you, Shekhar Saab, to give the concluding perspective before we move to the chair. Thank you.
Thank you very much, Professor Krishnan. Very good afternoon to all the panelists and the participants in this August forum. I really appreciate the opportunity provided by the chair of this panel, Deputy Governor Reserve Bank, and Professor Krishnan. Now, I thought I'll, with the experience of having been an ombudsman, as Professor Krishnan was saying, let me give some set of pointers of the performance of the ombudsman schemes implemented by the Reserve Bank. You are aware 3 schemes being implemented by RBI for banks, non-banks, and on digital transactions for the system participants. Which will set the context for my discussion, as also to address. It will also, I hopefully, will address some of the points discussed by the various panelists. Let me get to 2019-20, the performance of which is the last published one available. The total number of complaints processed all India was 3.3 lakh number of complaints under all the 3 schemes. This actually constituted an increase of about 65% over the previous year. So what could be the reason? From whatever we could assess, there were several reasons. One we could see is that clearly there is a level of awareness about the schemes which has come about by various public campaigns launched by the Reserve Bank, as also the communications which are sent out by the bankers, which needs further improvement. We are well aware of that. So more trust, more efficient disposal has been seen in the recent past. Ease of access is another thing what we have observed. As most of you will be aware, RBI implemented the computer management system, complaint management system over the online portal. In fact, of the complaints that we received, about 85% were received electronically then. Now, other important reasons what could be here is where our concern actually comes. Some of them were already narrated by the panelists. I would like to highlight them. One is a complex set of unsuitable products vis-a-vis the profile of the consumers that we observed based on the complaints. Deficiency in consumer sensitivity also was noted in certain cases. Apart from that, grievance redressal deficiencies were observed. Otherwise, most cases should have, what we have seen, they should have been taken care at the first resort level itself at the banks or the non-banks who are regulated. Repetitive complaints is another thing. We have seen a similar set of complaints, whether it is ATM, whether it is UPI, whether it is online, other transactions. We have seen that, which shows that the RCA mechanism is not as effective as it should have been. Other things we have seen is inadequate understanding among the frontline staff as well as by the outsourced service providers like the help desk personnel and all. We have noticed in certain cases. And of course, certain things are like technical issues in new products are also there, and inadequacies of the awareness programs on use of the solutions appropriately by the regulated entities. This we have observed. Now, coming to complaints on digital modes of transactions, where a lot of focus seems to be on in this session. We found that about a whopping percentage of 45, nearly 50% of the total number of complaints were on the digital transactions, digital modes of transactions. While this is disconcerting, this has been a disconcerting trend in the last few years, but we should also keep in view that some of these grounds like mobile banking induced transactions, they were not covered earlier under the scheme, which they have come about in the last couple of years. That is one reason, but it's all the same. It's a matter of concern that it is increasing, but again, we need to see it in the background of the number of complaints, the vast volume of about 35 billion complaints, 35 million transactions, retail transactions in the sector, financial sector, during the same year 2019-20, as per the published data. Now let me get to the disposal. Disposal is 92% disposal at the end of the year. Resolved of this, mutually settled or agreed, constituted 72%. But we need to really, come up with the, a fair analysis needs to include the fact that about 45% of the complaints were found non-maintainable for the reason of mainly insufficient information despite providing the opportunity. As also, there are cases which are number of cases where they are not covered under the scheme, banking ombudsman scheme. So how do we address this? Some of these measures were already announced by the Reserve Bank. Other things are on the way. One of the things, very important things, is there's one ombudsman, one nation dispensation, where this jurisdictional constraint has been completely removed. That's going to be implemented very soon. Wherein the complainants will have just one source to which to apply to file their complaints, and that will get separate. That will get shared among the various ombudsman officers. for appropriate resolution in a timely manner. So that jurisdictional issue is taken care. The delays will not be there on account of that in any case. Then the other thing is the issue of the delay on the part of especially the regulated entities in responding to our complaints. That has been taken care of. Hopefully will be taken care of by a large measure of this stringent measures introduced on the strengthening of the consumer grievance redressal system in the banks, which includes disclosure mechanism, which is going to be much more nuanced than what it has been. Supervisory action as required, and the disincentive scheme on recovery of, including recovery of the cost of the ombudsman officers in processing the complaints. One of the three criteria is going to be on digital transactions vis-a-vis the peer average. If it's going to be more for any bank, set of banks or regulated banks as of now, it may get extended to other regulated entities as well. That's going to be levied on the concerned entities. Now, these are some of the measures which have been taken. Now, coming to the action plan, what I propose, there are two things. Malvika is referring to structural level. I'm also referring to a structural level, probably from a different context. This is about the complaint resolution. I just mentioned about one nation, one ombudsman concept. I think going forward, there is a need to, we need to explore possibility of seamless integration of the complaint resolution at the regulated entities and the ombudsman. In fact, the number of complaints, despite all the awareness, whatever has been generated, we see that it's still not percolated down, especially in the rural areas, and people who are not that literate to understand even our whatever other outreach programs we have conducted and the media campaigns that we have conducted. So what we see is about 330,000, which seems to be a huge number. It in fact is pittance vis-a-vis the actual number of complaints received by the banking sector or the non-banking sector. Which being the case, I feel that there is a case to consider seamless integration of the complaint resolution and the RV at the REs as well as the ombudsman offices, wherein, say for example, beyond a preconceived period, predefined period, if the complaint is not closed, it does or it is rejected, it gets flown to the ombudsman offices automatically, system generated. Now, in a sense, you can also call it as a national complaint lodging center at one place in one database. It can get migrated further in that kind of a model. Where it's one system where the consumer complaints, and then it gets percolated based on the bank wise whatever stuff, and then gets addressed there, and then if not, as I already mentioned, it gets flown to the ombudsman offices. So this is another area where we can look at it. Now this can pave further in due course, maybe in 3 years time down the line or so, implementation of artificial intelligence, machine learning, etc., which can facilitate consistent and swift decisions, identification of trends as well as the systemic issues. Now, if you look at it, in a sense, it can be called as an online dispute resolution system, as it is even now, but it can become even more, much more sophisticated, where rule-based decisions can be taken, which is enabled by the system. Given the volume of complaints, I think it makes a lot of sense to go ahead to that kind of a mechanism. Other things what we have seen is the ease of access by the common man, as we have seen that number of complaints are getting rejected on account of lack of information, adequate information. In fact, the information required by the ombudsman are not much, I can tell you. It's only the date of the transaction, which is the bank involved or the non-bank involved, and the amount involved. That's all is the minimum required, more often than not. Subsequently, any additional information is required, we can always call for it. That's what the ombudsman does, but unfortunately, even that has not happened in many cases. But what we are looking at is the literacy is obviously an issue in putting it in writing, even in a mail or even in an online mode. So I think we need to graduate to chatbots, IVRS, chatbots also again literates to a large extent, but IVRS will be very useful, and SMS and mobile app-based. When somebody is using say UPI, he can as well complain through that mode itself in regional languages, as was mentioned by one of the panelists as well. So what can be the other thing is the IPA, this IBA. I'm just concluding, sir. Here, IBA, for example, industry associations like IBA, they can come together and then they can, along with the partnership model with so many other entities which are there, including the fintech players that we are talking about, they can come about with effective model of campaigning. What we have seen from our experience is storytelling, whether it is positive or negative, really impacts the consumers. So that should be one of the strategic parts of campaign. Also, very important, we have seen, for example, I can give the example of Gujarat, the ombudsman in Gujarat office. In Ahmedabad, what they have done is they have taken the profile of various consumers, whether it is women, whether it is rural, urban, literates, semi-literates, etc. And they were brought together and then they designed one in the regional language. They were shown to them based on their suggestion, then it was modified, and that was found to be extremely successful one. So going forward, I think these are some of the measures that we need to look at addressing. It's again, I should thank for the opportunity provided, and I'm looking forward to further discussion as it goes along. Thank you so much, sir.
Thank you very much, Mr. Shekhar. Again, very comprehensive. Given the 10-minute constraint, a very competent coverage of the issues involved. Now, with Chairman Ravi Shankar's permission, I'm going to slightly modify the original program. Ravi, we've taken a little longer than we had planned. So what I'm going to do is, rather than handle individual questions, given that we can and we want to conclude exactly at 1:05 as planned, I don't want to extend the time beyond that. There is one question that has got posted. It's a very comprehensive question. You can take a look at it. And what I would suggest is we will take exactly 10 minutes because we don't want to cut into the Deputy Governor's address to all of us. I would like to go through the same sequence of our panelists who can address each other's points as well as the comprehensive question that has come up, and take exactly 2 minutes. And I'd request you to take exactly 2 minutes because otherwise we'll be cutting into Deputy Governor Ravi's time. So Samir, Shrikant, Naveen, Malavika, Shekhar Saab in the same order, 1.5 to 2 minutes each. Very quick responses to some of the issues that have come up. Samir, can we go with you first? Any quick responses?
So, I'm assuming you're talking about the anonymous attendee question?
Yeah. And anything else that you want to cover in response to other points made by panelists?
Sure. So I think in there, there is one very interesting question around the Aadhaar system being used for greater financial literacy. I'll liberally sort of extend that to just, can we use the Aadhaar system to expand financial inclusion? This was paucity of time, couldn't cover that element. I think one of the really sort of exciting opportunities in front of the fintech industry and the technology industry is being able to really properly harness the public infrastructure, public-private infrastructure that India has created. And eKYC is one of the largest of them, amongst them. There's variety of initiatives going on that front. In fact, RBI has taken a leadership role there as well on a project called KYC Setu. I think eKYC and Aadhaar-enabled financial inclusion drives can really help both drive up financial inclusion for rural women, but women overall. As we know, a lot of the formal banking is done by the men in the family in India today, and I think empowering people on a mobile device. We've seen this in e-commerce, by the way, in my other life. E-commerce participation is a lot more secular than the BFSI industry is, and I think that's a very exciting prospect. I think the second one again is on small investors. I wouldn't say school children, but I definitely think that college students, there is a case to be made about getting millennials and Gen Zs educated on financial products. There are governments in Delhi and Assam and a few other states that have started programs, formal programs on entrepreneurship, for example. I think there should be a few chapters in colleges across streams around how to actually improve lives and livelihoods using financial products that are accessible to them. I think that would really help. I've seen this in the US personally. The day you land on campus, there are 20 institutions trying to offer you your first credit card, your first loan, your first EMI. I think it can be super helpful. I think it's a fantastic idea.
Thank you, Samir. Shrikant.
Yes, sir. So I'd like to quickly place a couple of comments, and probably we need to kind of see creative ways of literacy and awareness as well. And probably one suggestion is the Jamatra movie on the Netflix probably had a greater impact on delivering how frauds take place. Probably RBI should yearly fund a movie like that, which can radically kind of educate consumers in a very different way, right? And on measurement of fraud, like Naveen mentioned that independent measurement of like we have low levels of fraud, but I have a different point of view there. Like we need to have an independent measurement of fraud, because we are dealing with a demography that is low literate in a remote rural person, that the person does not even know that they are a victim of fraud, and so they won't even report it. So we need to, Samir mentioned the use of data on fraud detection and monitoring. This is kind of left currently to the PSOs and the PSPs themselves to kind of take in. But we need to find a way, like how can we let that person know. And on the other point I had quickly was on the harmonization of turnaround times. Like it is important to have a working guideline in force rather than a super ideal regulation that keeps having extensions, and because the industry doesn't find it monetarily fair. Because at the end of the day, consumer is happy when the systems work reliably, and I'm not as much interested in getting a compensation for the failed transaction. I'm more interested in getting fewer failed transactions in the first place. So I probably need to have a working guideline on the harmonization of that than one that extends perpetually. Yeah.
Thank you, Shrikant. Now, Naveen-ji, any quick responses?
So, sir, two key points. One, I think there is an assumption that most entities, fintechs, big techs, don't want to act responsibly and don't want to service the customer. First, I would want to say that, again, some of us are entrepreneurs, we run our company. It's too big a loss for us, having spent money to acquire a customer, having rolled out a product, spend money behind marketing, and then lose him and have a failed, let's say, satisfaction level. I don't think that understanding or that thought process or assumption is right. I don't think the issue is intent there. I think the growth that has happened with the back of capital, money, time, effort, innovation that has happened, and in educating that. Yes, there are challenges around complexities of the products at the pace they're growing, at the pace the adoption is happening, at the pace the social changes in technologies and challenges have imposed. Now, I would go, so that was the first point. Second point, I would just go back to that school example. See, you don't want to explain a school kid the nuances about legal, right? You need a program for a different age group. I think 90% plus population would use money. The moment you're in a 4th or 5th standard, your parents start giving you some money in some form to start using it. So I would say 90% of the population is relevant. However, the communication, information, and education that needs to be given to them needs to be broken down into different steps. For an example, you wouldn't want to give a kid ideally as just the physical money. At some stage, you would rather give them a wallet because bank account is still not relevant for them. But the moment, let's say you start becoming a college student, cross age of 18, you need probably understanding of banking, a debit card. The moment you're getting into a job, then like Samir said, you're getting exposed to credit card and other products because you have an income level. So we need to stagger the program. And this is where the design principle of industry, academicians, regulators, everybody putting together and put that right level of information at the right time in a right way is what is critical. And it is solvable. And on the other hand, if we really digitize even the customer servicing side and a monitoring of that digital way, Malvika had just said a link on a heat map of complaints. I mean, there are tools available. We just need to probably get our act together and do it. It's doable.
Thank you. Thank you, Naveenji. Malvika.
Thank you. And just to pick up on what Naveen had mentioned, I'll share the link to the audience as well. But I think we have a really important role is here making more complaints data publicly accessible, aggregated and privacy consciously, of course. Also transaction failure data publicly available. All of this is in the payment system, and most other regulators are able to release this publicly. The CFPB, for instance, aggregates this and shows you in the US by state of the US what kind of levels of complaints are, who are particular types of products and so on. So I think we can do much more there. I think the other thing I quickly wanted to check on from the open question is just this idea of how do you expand inclusion through digital and gender. So one thing I did want to flag is that the one same kind of consumers are of different types. So for women, what we find actually the case is that many of them may be pushed away from digital products because in Indian homes, there's a lot of gendered norms around ownership and management of the mobile instrument. And therefore, you really need to be careful about whether you are reducing a woman's autonomy or increasing it by forcing digital payments on them. So while we're doing that, while we support digital empowerment, I think it's important to think about how do you design for assisted technology? What are the safeguards do you have there? And can you do things like increase female agents in the BC networks? Because ultimately, these are the people that anyone in our society goes to. You go to an Airtel shop, which is not a BC perhaps, but also you go to a banking correspondent and you ask for help. How do you sensitize them to bring in new people into the, and in a consumer protecting way? So I think at two levels, one is make more data available from the system in order to create feedback loops. And on the other hand, really think about more clearly and carefully about different types of consumers and don't just lump them all into one consumer protection mandate. Thank you.
Thank you. Thank you, Malavika. Shekharji, any quick 1 minute additional thoughts?
Yeah. This is about the frauds which are being talked about. I have a point to make here. Yes, it's it's more often than not we see that there is lack of understanding by the consumers and they compromise their credentials. At the same time, I believe that the participants cannot disown their responsibility, where the mandated requirement of transaction monitoring, fraud detection, as also the KYC and taking up with the other entities, beneficiary entities, they are to be taken up more seriously than they are. So, for example, a simple question of financial ombudsman of UK, an example is that they go by the intent, compromise the intent of payment, whether it was there. If it's not, the ombudsman, in fact, decides in favor of the consumer. That's there. Regarding the data part, what Malavika said, I believe that, as I already mentioned, RBI has already imposed additional data requirements on the banks for comparison, individual banks, so that peer group also they can compare and take informed decision. That's another thing which has come about. And to reduce the more of recurring complaints, etc. I believe that there has to be a feedback loop within the regulated entities, where they need to communicate better between the consumer grievance vertical and the other verticals like compliance, risk management, etc. Thank you.
Thank you. Thank you so much, Shekharji. Now we are going to move to the most important part of the day's events, the remarks of the chairman. Raviji, you've heard a very diverse set of views, and I guess it's always the difficult job of the regulator to reconcile the irreconcilable, balance the non-balanceable. And over to you. And I'm sure you've seen, in addition to the remarks that have been made by our panelists, some of the questions that have come up, including what people think are disproportionately high specific convenience charges, that airlines and hospitals put whenever one uses a credit card or digital forms of transactions. So all of these difficult questions now over to Ravi. And really, there is no time limit. You are, we are all keen to hear you. So at least 15 minutes as originally scheduled, and anything beyond that, because after this, there is only a 1 minute vote of thanks that my colleague in NCAER will perform. Over to you, Ravi, and we are all very keenly looking forward to hear you on all these topics. Thank you.
Thank you, Dr. Krishnan. You say the regulator's job is difficult, reconciling the irreconcilable and so on and so forth. Have meetings like this, webinars like this, things tend to look a little bit easier, than what you have been otherwise thinking, and things also tend to look a little bit more promising than what you otherwise start thinking. There have been so many ideas that have come up. To be honest, I did not really expect so many new ideas that could come up. I thought we have been thinking and trying to second guess the requirement of consumers, and and try to do things well ahead of time, ex ante, as is the keyword here. We've been doing all that, but then you come to a meeting like this, and people come with suggestions, and you realize that there's still plenty you can do. I'll just briefly go through some of those ideas. I'm sure the organizers have listed them down. I'm sure they will be further discussed. They will be looked at by the regulators as well as by others. But some of those ideas are really good. Especially for example, the suggestion of doing consumer education, expanding the reach of consumer education by leveraging on, let's say, management institutes. Now, that's an idea. You might extend it from management institutes to, let's say, economic graduate courses, if you like, or even postgraduate courses. But the very idea is something that says that the reach of financial education, payments, digital education, which is a constraint that a regulator or even industry always sees, can probably be addressed importantly, going through that route. But the suggestion by Srikanth to have an institutional mechanism to review regulation is a very good suggestion. One thing that we as a regulator, and I think all regulators, financial sector regulators, at least I'm aware of, do is keep a constant level of interaction at various levels, operational levels, right at the initial stages of the hierarchy, right up to the top levels. They keep a conversation going with the regulated entities. So in a sense, there is a feedback, but it's nonetheless a good idea to have a formal feedback mechanism and review it periodically, tick off what you can do. If you can't do something, engage further with the industry and explain. I think the transparency of not just the regulation mechanism of the whole industry would improve substantially. That's a good suggestion. The point that Samir raised about use of local languages, how while it hasn't really contributed much to actual transactions, is extremely useful in terms of dealing with redressal, dealing with complaints, getting into conversation. Made me start thinking about whether we as a regulator can do certain things in a language that would reach a wider level of audience. But this is something that obviously service providers, regulated entities would be thinking, as Samir says, they have been thinking. Others would also be thinking, but that's that's a good idea to identify areas of operation in our respective fields where one could do fruitful and profitable use of local languages. The other point that Samir raised was, gave me food for thought. I do not know, whether there is a solution to it. I do not know whether others have thought about it, but his suggestion that to take on the liability of fraud by a service provider, one needs to have a robust revenue model. There again, various issues come up. Is the price market determined? Is the price efficient? Is the price consumer friendly? These are issues that come up. But if assuming somehow we manage to reach what is an efficient price, would the industry then be able to take on the liability of fraud? It's not such an easy question to answer, but he raised a fairly important point. There have been similarly, there have been a lot of such suggestions. We will look at those carefully. What I would like to to convey just 2 or 3 larger points. All the detailed suggestions we'll examine, but the larger points. One is that we need to, I think, appreciate that the digital payments industry is hardly, it's not even in its teens, more or less. It effectively started after 2010, and it's hardly about 10 years, 12 years, that the industry has had. It has achieved immensely. It has become the global leader in certain areas. What we have in India, whether it's fast payments or whether it's 24/7/365, NEFT or RTGS and so on. It has achieved a lot, but we also have to realize that we are still at an evolving stage, and in the stage, given the various stages of evolution, sometimes some decisions taken in terms of pricing. Markets are never mature in the initial stages of evolution. I know of the financial sector, which has pretty much started developing after the early 90s. It's 30 years now. But even then, you don't have the depth to ensure that market forces themselves would reach an efficient pricing in various sectors of the financial economy. So it is not easy to reach a proper financial or a proper pricing mechanism by leaving it entirely to the market. Some amount of state intervention, regulator intervention, does come up, is required. But having said that, one must realize that all these interventions, etc., are in essence, temporary phases in the eventual evolution of the industry, where one could largely depend on, market-determined pricing. So while we have our issues on pricing, while we have our issues on, market concentration, one has to first of all start off with the belief that. With the understanding that we are at an initial stage of evolution. We still have a lot to do. We still have a lot of untapped potential from a business perspective, and untapped potential from an economic development perspective for the states, for regulators and the government. The offline segment, Reserve Bank is making a lot of efforts to tap the offline segment, tap the segment that uses feature phones. The systems like UPI are largely inaccessible there. And plus, a large number of people who, because of, lack of adequate financial awareness or education, you might say, are still not, able to access or willing to access this system. We have to develop the ecosystem in a way that it gives comfort to everyone, to all citizens, to be able to use these systems, to feel that yes, my money would be safe if I access these systems. And for that, customer education and customer protection are key things that regulators normally focus on. On the issue of concentration, the answers are not so so straightforward. Those of you who have done finance or economics would say that a competitive market gives the best possible price, which is which is true enough, except that the conditions of competition that we read in textbooks are conditions of competition that rarely exist. That's number one. Second point is, in terms of infrastructure, the belief that a competitive market would lead to the best solution, I have not seen that happen in the areas that I have looked at. I have looked at closely in finance. Look at exchanges, for example, stock exchanges. How many stock exchanges are active per country? 1, 2. Now, even in countries that strongly believe in competition, many of you, some of you at least might know that the London Stock Exchange, the London Clearing House accounts for roughly 75% of all, settlement of 75% of all derivative transactions in the world. So that is the level of concentration that you reach, when you leave it to competitive forces. There is a fairly strong argument to be made that if it is financial infrastructure, probably it might in fact make more sense to keep it out of competition and develop them as public goods. There is a fairly strong case for that. India has only one, in terms of OTC, has only one central clearing house. It has been working. There has been no price gouging. It depends on the governance structure that you develop. All these are subject to international global standards. So it is very difficult for these entities, so long as you treat them as public goods, for pricing inefficiency to come in, even if there is no competition. Now, this is something that we have to have in mind, that when we are talking of financial infrastructure, or when we are talking of payment system infrastructure and payment system participants, it is not a one-size-fits-all. It is not competition that is necessarily the best solution to both infrastructure and participation by agencies. So there is no clear answer as such, but I think it would be useful if everyone started thinking of infrastructure as public good, and therefore find solutions that are consistent with public good. What follows from this is essentially pricing. The fear of concentration is monopolistic pricing. That is what adds inefficiency. That is what increases costs for everyone. That is what increases prices. I read a little bit in terms of newspaper coverage of pricing of healthcare in some developed countries, particularly US. Some of the cases you read are unimaginable, and they are all market determined. They're all free market determined. Compare that, for example, to pricing of health services in countries where it is provided by the state, many in the Scandinavian countries and so on. They're as effective, far cheaper, and as efficient. So, there is no clear answer that competition always leads to an effective price. And when it does not, and then there is no clear, clear view to take on whether pricing is better for the consumer when you leave it to competitive forces, or when you leave it to, leave it to the state. I mean, I'm talking of, for example, health services here. So when you think of pricing, So when you think of pricing, I think what we have to understand is that given the stage of our evolution of our payment systems, what we are focusing on now as a state, as a regulator, is that you have to get more and more people in. There is an industry which is contributing a lot, in terms of innovation, in terms of providing products, in terms of making it easy for people to come in. But as regulators and as the state, we might also have to look at issues of how do I get more people in? In the short run, is it a good idea, for example, to get more people in if I subsidize their pricing? These sort of issues do come in. Some decisions, are taken in the process. Whether these decisions are in the best interest of the evolution of the sector, evolution of payments, history will tell us. But I think one thing we can all be certain about is that all these that are happening are subject to change. We are all constantly getting feedback. We are all constantly looking at these things, and we will all constantly modify our approaches to regulation, including pricing and all that, as we go along. So that is the other point I wanted to focus on. The third point, which is important, is in terms of data privacy and data monetization. While many of the participants have talked about data privacy and how data should be protected, they are extremely important issues. We are globally, everyone is trying to deal with it. We are trying to deal with it within our country. We have certain regulations in terms of data storage and so on. There is another aspect, which I personally think is happening is that, a huge amount of data is getting monetized. Data, as people say, is the new oil. Now, if a huge amount of data is getting monetized, typically, for consistency, if something has to be consistent, if you have obtained a good which can be monetized, you should ideally have paid for it. In terms of data monetization, this part of the left side of the equation is not something that is very clear to me. I think data privacy and data monetization both can be achieved if we start thinking. I don't know the solutions, but if I start, if all of us start thinking in terms of how a person's data that originates from a person, if data that I put in my account in Facebook, if it's being used by some business to expand its customer base, which is fine. The point is that all those need to assure of two things. One is that I, as a creator of that data, need to be okay with that. My permission is important, and that permission ideally should not be hidden in a 30-page terms and conditions document. That permission should be explicit. And secondly, to ensure that the monetization of that data is clear to the user. I think someone talked about monetization of data or use of data and then feedback to the original source of that data. If the monetization of that data has to be transparent, then we have to have pricing that does not, that is very transparent. We cannot have a pricing system where someone says, I'm giving you this free service, in return I use all your data. Pricing is extremely opaque there. There is an amount of pricing, even happening in the free service, but that is hidden. Now, whenever such opaque arrangements, someone talked about bundling. Bundling is such an arrangement. I have seen that in financial sector quite a bit. Typically, that tends to favor the seller of the product vis-a-vis, the consumer. So when bundling and such issues come up, I think regulators need to be more alert to the possibilities of mis-selling and misuse. I think the industry also needs to look at making pricing very transparent. Whenever you can price all your services, and keep pricing distinct among a multiple of services that you are selling. I would try and end by basically reiterating that we have received that most of the suggestions we have received, we will have a very close look at in terms of what pertains to us, in terms of the suggestions on having separate coordination, or in terms of the suggestion on funding law enforcement to enforce payment related issues, etc. Other agencies might be involved. We will try and take that up with other agencies, based on internal deliberations. This has been, I don't know about the other participants. This has been an extremely useful interaction as far as I'm concerned. There's plenty that I have learned. My gratitude to Dr. Krishnan, as you said, my erstwhile boss. My gratitude to him for putting this together. Maybe we can have more of these things, and I look forward to interacting with you, all those that I have got to know through this webinar going forward. Thank you so much.
Thank you very much, Ravi, for a very masterly coverage of all the diverse issues. You did sort of, as I requested, try and reconcile the irreconcilable and balance the non-balanceable. But you've actually given us enough material to go on for a couple of hours more. But as agreed, we will conclude at the appointed time. And but I want to take up on your very generous offer of carrying this conversation at a later on a later occasion in a different fora. I will, on behalf of everybody, on behalf of NCAER, let me thank Rabi, his colleague, Mr. Vasudevan, Mr. Khandelwal of the RBI Payment Systems team, all my assembled NCAER colleagues, all the distinguished panelists, and all the audience who gathered today for this excellent webinar. We've gained a lot, and we hope to use all of the knowledge gained today into the report that I mentioned early on. Before I conclude, I also want to thank my senior colleague, Dr. Shashank Bhide, for being with us throughout the day today and for formally inaugurating the seminar today. Thanks all of you. Look forward to seeing you tomorrow. We have the 5th and the concluding webinar of this series, which is on the same set of issues on consumer education and protection in banking and credit. A very good day to all of you. Thanks again, and look forward to seeing you soon. Bye-bye.